For the first time in modern history, America tried to sell its debt, and the world shrugged. $119 billion in bonds went on offer, and the silence that followed was louder than any crash. Investors aren't panicking, they're walking away. China's trimming, Japan's defending its own currency, and Washington is paying record interest just to stand still. The question isn't how much debt the US can issue. It's how long the world will keep pretending it's risk-free. The trading floor was already tense before the first number even hit the wire. The Treasury had just unveiled its latest lineup. $58 billion in 3-year notes, $39 billion in 10s, and $22 billion in 30s. In total, $119 billion that Washington needed the market to absorb. Dealers were calling it a routine auction, but behind the calm language, desks were bracing for impact. The short-term sale went surprisingly smoothly, clearing below pre-auction yields. But the long bond told a different story. Primary dealers were left with a smaller share than usual, meaning real money investors were taking more exposure, but at higher risk. In earlier auctions, coverage ratios had slipped to their weakest levels in more than a year. Traders were starting to see a pattern. The government could still sell its debt, but only by offering ever richer rewards. That is not a short-term glitch. Funding desks warned that this cluster of settlements was draining liquidity just as the Federal Reserve continued to shrink its balance sheet. The combination meant fewer automatic buyers for treasuries and heavier reliance on open market demand. Meanwhile, the deficit was still hovering near $2 trillion, and interest costs had climbed past $1 trillion, now rivaling Social Security as one of the largest federal expenses. Treasury data shows the national debt edging close to $38 trillion, with new borrowing outpacing revenue by hundreds of billions each quarter. Each additional percentage point in borrowing costs adds tens of billions in annual interest, money that no longer funds defense, healthcare, or infrastructure. Foreign demand has also shifted. China's holdings have slipped towards $700 billion, down from previous years, while Japan remains near the $1 trillion mark, but has been adjusting positions to manage its currency. When large sovereign buyers trim exposure, domestic institutions must fill the gap, and they often demand higher yields to do it. At the policy level, Treasury Secretary Scott Bessent has been meeting counterparts in Tokyo, urging coordination as global rate differentials keep whipsawing long-term demand. Japanese life insurers, sensitive to currency hedging costs, have become cautious about unhedged U.S. exposure, creating ripple effects through every 30-year auction. Treasury bonds are not just numbers on a Bloomberg terminal. They set the reference price for everything else: mortgages, corporate loans, municipal debt. When the stop-out yield rises, the cost of money rises with it. Mortgage rates follow, auto loans tick up, and credit card interest climbs. A weak auction in Washington can push up the monthly payments of millions of households within weeks. The fiscal math keeps compounding. Even though the deficit narrowed slightly this year, net interest payments rose again, setting a new record. The Treasury has leaned more on short-term bills to avoid pressure on the long end, but that only postpones the problem. The maturities roll over faster, meaning the government must refinance more often at whatever the market demands next. Inside the Fed, officials continue to let the balance sheet shrink. They know that stepping back in as a buyer would risk reigniting inflation, but their restraint leaves the Treasury with fewer safety nets. Dealers now price every auction with that reality in mind. There is no guaranteed backstop, only the market's tolerance. Households are already feeling the translation. Higher Treasury yields feed directly into mortgage rates that now sit above 7%. Auto financing and credit card borrowing have become more expensive. For retirees, the higher yields help new savers, but erode bond portfolios built in the low-rate years, cutting the market value of existing holdings. Institutional investors face similar strain. Pension funds and insurance companies must rebalance as duration gaps widen. Volatility in long bonds forces hedging costs up, while municipalities see their borrowing costs climb for hospitals and schools. What begins as a soft auction ends as a harder life for local finance officers trying to fund basic projects. Globally, the United States still benefits from the dollar's reserve currency role. Most international trade and reserves remain denominated in dollars, guaranteeing a baseline level of demand for treasuries. But that privilege depends on trust, in fiscal governance, in inflation control, and in political stability. If investors begin to question any of those, they demand compensation, and the term premium rebuilds quickly. That is already happening. For years, investors accepted negative term premiums, effectively paying for the safety of treasuries. Now those premiums are positive again, reflecting a demand for protection against fiscal drift and policy uncertainty. The United States can still finance itself, but each new auction comes at a steeper price. Political debates have done little to ease concerns. Temporary spending agreements avoid shutdowns, but do not reduce structural deficits. Health and retirement programs continue to expand alongside the cost of servicing the debt. Each month's Treasury statement confirms the direction, interest payments climbing faster than any other major outlay. The bond market measures credibility minute by minute. When a 10-year auction tails or a 30-year clears with weak coverage, traders are not just pricing securities. They are voting on confidence in the United States' ability to manage its finances. So far, the vote is still yes, but with conditions. Those conditions show up in the yield curve. The front end reflects monetary policy, the back end reflects fiscal policy. The more investors worry about deficits, the steeper the curve becomes as they demand extra yield to hold long-term paper. Each auction that struggles reinforces that signal, feeding back into higher rates and, eventually, higher debt costs. For the Federal Reserve, it is a narrow corridor. Easing too soon could reignite inflation. Tightening too long could destabilize Treasury markets. Either path risks undermining confidence in United States debt. And once shaken, that confidence takes years to rebuild. The domestic consequences are already visible. New home buyers are, priced out. Small businesses face higher financing costs. States are delaying bond-funded projects because yields are just too high to make budgets balance. And, well, all of it traces back to the Treasury's need to pay more to borrow. Meanwhile, global demand patterns are, fragmenting. Emerging markets are experimenting with regional settlement systems and currency swaps that reduce their dependence on the dollar. Each marginal shift erodes a sliver of built-in Treasury demand. It is not a collapse, not yet, but it does signal that the world's savings are no longer guaranteed to flow through Washington by default. Every 1 p.m. auction in New York now carries, honestly, a lot of symbolic weight. Dealers watch the stop out. Foreign desks watch the coverage. Central banks watch the reaction in swaps. The United States can still sell its debt, for now, but the margin of comfort is narrowing, and the cost of complacency is compounding. When the results hit the tape, traders mark their books, recalibrate hedges, and move on to the next issue. But outside the trading floor, the consequences stretch longer. Higher yields reshape household budgets, corporate strategies, and government priorities. They determine who can afford to build, to borrow, and to retire. The auction calendar will roll on, more 3s, 10s, and 30s, more hundreds of billions needing homes. Whether the demand holds depends less on the ritual of issuance than on the arithmetic of trust. A trust that the government's promises remain worth their yield. The question isn't whether America can find buyers today, it's really how long investors will keep lending at any price before asking for a different story. Wall Street desks call it, the saturation point. Behind that phrase lies a pretty blunt reality. U.S. debt issuance has reached volumes we really haven't seen outside of wartime, and the buyers who once absorbed it almost automatically are now rationing their exposure. Treasury borrowing in the final quarter is on pace to exceed $800 billion, according to estimates compiled by Bloomberg, which is, honestly, a record for a peacetime quarter. Dealers are noting that even minor shifts in demand now move yields by entire percentage points, a sensitivity that just didn't exist when the Federal Reserve was still a major buyer. At the same time, U.S. money market funds, historically a pretty quiet source of demand, are starting to balk. Data from the Investment Company Institute shows that cash managers are rotating into the Fed's overnight reverse repo facility, preferring its risk-free return to buying short-dated treasuries that can swing pretty violently during auctions. The result is less depth at the front end, even as the Treasury is relying more heavily on bills to fund itself. Foreign behavior is diverging too. Japan's Ministry of Finance has hinted that rising U.S. yields are becoming, a two-edged sword, supporting yen carry trades but deepening unrealized losses for Japanese institutions already sitting on mark-to-market pain. Meanwhile, China has continued to trim its U.S. holdings, redirecting some reserves into gold and non-dollar assets, a shift documented by the People's Bank of China's balance sheet disclosures. Each reduction, even if it's modest, forces Washington to depend more on domestic capital markets that are already absorbing record corporate and municipal supply. One of the most striking shifts has been the surge in Treasury volatility, which is captured by the IC BofA Move Index, and honestly it remains near levels last seen during the 2008 crisis. Every basis point move now cascades through global portfolios that are leveraged on U.S. rates. Pension funds and insurers have to constantly rebalance hedges, and algorithmic strategies just amplify the swings. A failed or weak auction, even if it misses by just a few basis points, can ignite chain reactions that ripple through global credit. The banking sector feels it next. As Treasury prices fluctuate, collateral valuations used in repo markets change, which forces banks and hedge funds to post additional margin, tightening liquidity exactly when it's needed most. Back in 2020, the Fed stabilized this dynamic with trillions in purchases. But today, with balance sheet runoff ongoing, no such backstop exists. The result is a market that's more fragile than its sheer size might imply. Bond veterans warn that this fragility collides with political gridlock. Every continuing resolution fight or debt ceiling standoff pushes investors toward higher risk premiums. Credit default swap pricing on 5-year U.S. sovereign debt, once a curiosity, has quietly climbed above levels typical for AA-rated corporates. It's not a prediction of default, it's a measure of distrust. Meanwhile, global capital is watching alternatives. The European Union's common debt program has quietly become one of the fastest growing sovereign markets, offering liquidity without Washington's political theatrics. Gulf sovereign wealth funds are expanding exposure to Chinese and Indian bonds. Even marginal diversification chips away at the automatic bid the U.S. once enjoyed. Within the Treasury, officials frame the problem not as an immediate crisis but as a market recalibration. Yet the arithmetic is hard to soften. If average borrowing costs stay near current levels, net interest could exceed $2 trillion annually within a decade, more than the entire discretionary federal budget today. The implications stretch far beyond finance. Rising debt service crowds out investments in infrastructure and research, forcing trade-offs that shape the next generation's competitiveness. The U.S. can still issue paper. The world will still buy it, for now. But the auctions are no longer background noise. They are live referendums on the credibility of the world's largest borrower, held every week at 1 o'clock in the afternoon. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.